You're sitting at home right now, scrolling through social media, and you see another post from some 25-year-old claiming they made 6 figures flipping houses in 6 months. You roll your eyes because you've seen this story 1,000 times, but then you pause. What if they're not all lying? What if real estate investing actually works? Here's the truth. Real estate has created more millionaires than any other investment vehicle in history. Not stocks, not crypto, not starting the next Facebook. Real estate. Boring, unsexy, tangible real estate. But here's the other truth. Most people who try to invest in real estate fail spectacularly. They lose money, destroy their credit, and end up worse than when they started. The difference between success and failure isn't luck, it's knowledge. Today, I'm going to give you everything you need to know about investing in real estate. Not the Instagram version with Lamborghinis and luxury penthouses, the real version with actual strategies that work, realistic expectations, and honest talk about the risks and challenges. We're covering it all: how to get started with limited money, the different investment strategies and which ones actually make sense, how to find deals in competitive markets, financing options you've never heard of, how to analyze properties like a professional, and the critical mistakes that bankrupt beginners. By the end of this video, you'll have a complete roadmap for building wealth through real estate. Whether you want to replace your income, build long-term wealth, or just understand what all the hype is about, this is your comprehensive guide. Let's get into it. Part 1. The Foundation. Understanding Real Estate Investing. Chapter 1. Why Real Estate Actually Works. Before we dive into strategies and tactics, you need to understand why real estate is such a powerful wealth-building tool. And no, it's not just because they're not making any more land, or whatever cliche you've heard. Real estate works because it's the only investment that gives you 4 simultaneous profit centers. Let me break this down because understanding this is crucial. Profit Center 1. Cash flow. This is the monthly income you receive after all expenses are paid. If you rent a property for $2,000 per month, and your mortgage, taxes, insurance, and maintenance cost $1,500, you have $500 in monthly cash flow. Multiply that by 12 months and you're making $6,000 per year just for owning the property. Cash flow is king in real estate. It's the money that hits your bank account every single month, regardless of what the market is doing. While stock investors are checking their portfolios nervously, hoping for gains, you're collecting rent checks. Profit Center 2. Appreciation. Over time, real estate typically increases in value. The national average is about 3 to 4% annually, though this varies dramatically by location and market conditions. On a $300,000 property, 4% appreciation means $12,000 in equity gain per year. Here's the beautiful part. You're gaining appreciation on the entire property value, not just your down payment. If you put 20% down on that $300,000 property, you invested $60,000, but you're getting appreciation on the full $300,000. That's leverage in action. Profit Center 3. Loan paydown. Every month when your tenant pays rent and you pay the mortgage, a portion goes toward principal reduction. Early in the mortgage, most of the payment is interest, but over time, more goes toward principal. Your tenant is literally buying the property for you. On a $250,000 mortgage at 4% interest, you might pay down $5,000 in principal the first year. That's $5,000 in equity you gained without doing anything except collecting rent and making the payment. Profit Center 4. Tax benefits. Real estate offers tax advantages that are almost obscene. You can deduct mortgage interest, property taxes, insurance, repairs, maintenance, and even travel related to managing your properties. But the real magic is depreciation. The IRS lets you depreciate residential real estate over 27.5 years. Even though your property is probably increasing in value, you get to claim it's losing value on your taxes. On a $300,000 property, you can depreciate roughly $11,000 per year. This is a paper loss that reduces your taxable income without affecting your actual cash flow. Wealthy real estate investors often pay little to no income tax despite making substantial money because depreciation and other deductions offset their rental income. This is completely legal and one of the reasons rich people love real estate. Now let's add this up. On a $300,000 property with 20% down, you might have cash flow $6,000 per year, appreciation $12,000 per year, loan paydown, $5,000 per year, tax savings, $3,000 per year. That's $26,000 in total annual benefit on a $60,000 investment. That's a 43% return. Show me another investment that consistently delivers these kinds of returns with this level of security. But here's what makes this truly powerful. All four profit centers work simultaneously and compound over time. As rents increase, your cash flow grows. As the property appreciates, your equity builds faster. As more of your payment goes toward principal, you're gaining equity more quickly. And as your income grows, tax benefits become more valuable. This is why real estate creates wealth. Not because it's exciting or sexy, but because the math works consistently over time. Chapter 2. The brutal truth about getting started. Now let me hit you with some reality. Real estate investing sounds amazing when you list the benefits. The actual experience of getting started is often frustrating, overwhelming, and filled with obstacles. First obstacle, money. Despite what YouTube gurus tell you, you need capital to invest in real estate. No money down strategies exist, but they're exceptions, not the rule. Most beginners need to save actual money before starting. How much? For a traditional investment property purchase, you typically need 25% down plus closing costs and reserves. On a $200,000 property, that's $50,000 down plus maybe $5,000 in closing costs, plus reserves of another $10,000, you're looking at $65,000 minimum. Don't have $65,000, you're not alone. Most people don't. But this is your first test as an investor. If you can't save money, you can't invest in real estate. Period. The good news is there are strategies requiring less capital, which we'll cover, but you still need something. Maybe it's $10,000 for a house hack, maybe it's $5,000 for a partnership, maybe it's $2,000 for a REIT investment, but you need capital. Second obstacle, credit. Your credit score determines whether you can get financing and what interest rate you'll pay. A difference of 1 percentage point on a $250,000 mortgage costs you about $50,000 over 30 years. Bad credit is expensive. Most lenders want to see a credit score above 680 for investment property loans. Below that, you'll struggle to get approved or face much higher rates. If your credit is damaged, fixing it becomes priority number 1 before you invest in real estate. Third obstacle, knowledge. Real estate investing has a steep learning curve. You need to understand markets, financing, property analysis, negotiation, property management, tenant law, contracts, insurance, taxes, and about 50 other topics. The knowledge gap between beginners and experienced investors is enormous. This is where most people fail. They watch a few YouTube videos, read a blog post, and think they're ready to invest hundreds of thousands of dollars. Then they make expensive mistakes because they didn't know what they didn't know. Fourth obstacle, time. Real estate is not passive income initially. Finding deals, analyzing properties, securing financing, managing renovations, finding tenants, and handling maintenance requires substantial time. People who tell you real estate is passive are either lying or talking about their situation after years of building systems. Expect to spend 20 to 40 hours per month on your first property, maybe more if you're doing hands-on management or renovations. This is a part-time job initially, not a magic money machine. Fifth obstacle, risk. Real estate investing involves substantial risk. You can lose money. Properties can decline in value. Tenants can destroy your property. Major repairs can exceed your reserves. Market crashes can leave you underwater on mortgages. Natural disasters can devastate properties. Anyone telling you real estate is risk-free is selling something. Smart investors manage risk through research, insurance, reserves, and diversification, but the risk never disappears completely. The point of listing these obstacles isn't to discourage you, it's to set realistic expectations. Real estate investing is incredibly rewarding, but it's also hard work that requires capital, knowledge, time, and risk tolerance. If you're willing to face these challenges, you can build substantial wealth. If you're looking for easy money with no effort, you'll be disappointed and probably broke. Chapter 3. The different real estate investment strategies. Real estate isn't one thing. It's a category containing dozens of different investment strategies. Choosing the right strategy for your situation is critical. Let's break down the main approaches. Strategy 1. House hacking. House hacking is buying a property, living in part of it, and renting out the rest. This is hands down the best strategy for beginners with limited capital. Here's why it's brilliant. When you live in the property, you can use owner-occupied financing, which requires as little as 3.5% down with FHA loans. On a $300,000 property, that's only $10,500 down versus $75,000 for a traditional investment property. The numbers get even better. Your tenant's rent covers a significant portion of your mortgage, effectively giving you free or heavily discounted housing. Every dollar you save on housing is a dollar you can invest in your next property. Example: you buy a duplex for $300,000 with an FHA loan, you put down $10,500. Your total mortgage payment is $2,000 per month. You live in one unit and rent the other for $1,500. Your net housing cost is $500 per month instead of the $1,500 or more you'd pay renting somewhere else. You're saving $1,000 per month, which is $12,000 per year. In 2 years, you've saved $24,000, enough for a down payment on your next property. Meanwhile, you've gained appreciation and loan paydown on the duplex. House hacking works with duplexes, triplexes, fourplexes, or single-family homes where you rent out rooms. It's the strategy I recommend to almost every beginner because it solves the capital problem and reduces risk by giving you income from day one. The downsides? You're living with tenants, which isn't for everyone. You're on site when things break, so you can't easily ignore problems. And you're limited to properties you'd actually want to live in, which narrows your options. But for beginners, house hacking is unbeatable. Live in it for a year, move out and buy another property, repeat. Some investors build portfolios of 10+ properties in 5 years using this strategy. Strategy 2: buy and hold rental properties. This is the classic real estate investment strategy. Buy a property, rent it to tenants, hold it long term, and benefit from cash flow, appreciation, loan paydown, and tax advantages. Buy and hold works best for investors with long-term horizons. You're not trying to flip quickly for profit. You're building wealth steadily over decades through the 4 profit centers we discussed. The ideal buy and hold property generates positive cash flow from day one, is in a stable or growing market, and requires minimal maintenance. You're looking for boring, reliable properties that produce consistent returns year after year. Finding properties that meet these criteria is challenging in competitive markets. You'll analyze dozens or hundreds of properties to find one worth buying. This is where most beginners struggle. They get impatient and buy mediocre properties that don't cash flow well. The key metrics for buy and hold are cash-on-cash return, annual cash flow divided by total cash invested, and cap rate, net operating income divided by property value. You want cash-on-cash returns above 8% minimum, ideally closer to 12 to 15%. Management is crucial for buy and hold. You can self-manage to save money but sacrifice time. You can hire property managers for 8 to 10% of rent but sacrifice profit. Most investors start by self-managing, then hire managers as their portfolios grow. The beauty of buy and hold is compounding. Your first property might generate $500 monthly cash flow. That's nice, but not life-changing. Your 10th property generates $5,000 monthly, which is $60,000 per year. Now you're talking about serious income. The downside is that building a substantial portfolio takes time. This isn't a get-rich-quick strategy. It's a get-rich-slowly strategy that actually works. Strategy 3: house flipping. Flipping is buying properties below market value, renovating them, and selling quickly for profit. This is the strategy made famous by reality TV shows, and it's dramatically different from buy and hold. Flipping is a business, not an investment. You're trading time and expertise for profit. There's no cash flow, no long-term appreciation, no loan paydown, just buy, fix, sell, profit, repeat. The advantage is speed. A successful flip might generate $30,000 to $50,000 in profit in 3 to 6 months, and that's compelling if you need income now rather than wealth later. The requirements are steep. You need construction knowledge or reliable contractors. You need access to capital for purchase and renovations. You need skills in estimating repair costs, managing projects, and understanding resale values. And you need risk tolerance because flips can go spectacularly wrong. The formula for flipping is simple. Buy at 70% of after-repair value minus repair costs. If a house will be worth $300,000 after repairs that cost $50,000, you need to buy it for $160,000 or less. This gives you a $90,000 gross profit minus holding costs and selling costs. Finding these deals is the hard part. In competitive markets, motivated sellers are rare. You'll make dozens of offers before getting one accepted. You'll analyze hundreds of properties to find viable flips. Renovation is where flips succeed or fail. Underestimate costs by $10,000, and your $30,000 profit becomes $20,000. Go over budget by $30,000 and you have zero profit. Accurate estimating and project management are essential. Flipping can generate substantial income, but it's active work. You're not building passive wealth. You're running a business that requires constant attention. Most successful flippers eventually transition to buying and holding because they realize flipping is trading time for money. Once they've built capital through flipping, they shift to strategies that generate passive income. Strategy 4, BRRRR, buy, rehab, rent, refinance, repeat. BRRRR combines elements of flipping and buy and hold. You buy distressed properties below market value, renovate them, rent them to tenants, refinance based on the new higher value, pull your capital out, and repeat with another property. The strategy allows you to build a rental portfolio faster than traditional buy and hold because you recycle your capital. Instead of having money stuck in each property, you pull it out and redeploy it. Here's how it works. You buy a property for $150,000 that needs $30,000 in repairs. After repairs, it's worth $240,000. You rent it for $2,000 per month. You refinance at 75% loan to value on the new value, which is $180,000. If you initially invested $50,000 down payment plus repairs, you now pull out $180,000, recovering your full investment plus profit. Now you own a cash-flowing rental property with essentially none of your own money in it. Take that recovered capital and do it again. This is how investors build large portfolios quickly. The challenges are significant. You need skills in finding below-market deals, estimating repairs, managing renovations, and getting properties rented quickly. You need relationships with lenders who will do cash-out refinances on recently purchased properties. You also need capital to start. Even though you recycle money, you need substantial cash for the first deal. And if the refinance doesn't give you all your money back, you need reserves to keep going. BRRRR works best in markets where you can buy distressed properties significantly below market value. In expensive competitive markets, finding sufficient deals is extremely difficult. Strategy 5. Real Estate Investment Trusts, REITs. REITs are companies that own and operate income-producing real estate. You buy shares like stocks and you get exposure to real estate without directly owning properties. This is the easiest, most accessible real estate investment strategy. You can start with a few $100s. You have complete liquidity. You can sell anytime markets are open. You have no management responsibilities. You get diversification across many properties and markets. Publicly traded REITs are required to distribute 90% of taxable income as dividends, so they typically yield 4 to 6% annually. Plus, you get appreciation if the REIT's value increases. The downside is you give up control and the tax advantages of direct ownership. You can't depreciate REIT shares. You can't use leverage the same way. And you're subject to stock market volatility even though the underlying assets are real estate. REITs make sense as part of a diversified portfolio, but they're not a replacement for owning actual properties if you want to maximize returns and tax benefits. Strategy 6. Wholesaling. Wholesaling is finding properties below market value, getting them under contract, then selling the contract to another investor for a fee. You never actually buy the property. This is often marketed as a no money down strategy, which is technically true. You don't need capital to purchase properties, but you need money for marketing to find deals, and you need knowledge to identify good opportunities. Wholesaling is a business, not an investment. You're providing a service, deal finding, and getting paid for it. Typical wholesale fees are $5,000 to $15,000 per deal. The advantage is you can generate income quickly without capital or credit. The disadvantage is it's hard work. You're marketing constantly, analyzing countless properties, making numerous offers, and dealing with rejection regularly. Many investors start with wholesaling to build capital, then transition to other strategies once they have money to invest. Chapter 4. Which strategy is right for you? Choosing your strategy depends on your situation, goals, and resources. Let me give you a framework for deciding. If you have limited capital but can qualify for a mortgage. House hack. This gives you the best return on investment and lowest risk for beginners. If you have substantial capital and want passive income, buy and hold with professional property management. You're trading some profit for time freedom. If you have construction skills and high risk tolerance, consider flipping. Just understand it's a business, not passive investment. If you have moderate capital and want to scale quickly, learn BRRRR. It requires more skills but allows faster, more skills, portfolio growth. If you have very limited capital or want exposure without effort, invest in REITs. You won't get rich quickly, but you'll participate in real estate returns. If you have no capital but are willing to hustle, try wholesaling to build funds for other strategies. Most successful investors combine strategies. They might house hack their first property, use the savings to buy a rental, flip a property to generate capital, then BRRRR several properties to scale their portfolio. There's no single right answer. The best strategy is the one you'll actually execute based on your current resources and constraints. Part 2. Finding and analyzing deals. Chapter 5. How to find properties worth buying. Finding good deals is the skill that separates successful real estate investors from everyone else. In competitive markets, there are 10 buyers for every truly good property. You need to find opportunities others miss. Let me start with hard truth. Scrolling through, Zillow listings won't make you rich. By the time a property is listed on major real estate websites, thousands of people have seen it. If it was a great deal, it's already under contract. You need to find properties before they hit the market or in places other investors aren't looking. Here are the strategies that actually work. Strategy 1. MLS with a smart agent. The multiple listing service is where agents list properties. Most investors dismiss the MLS because everything is picked over. This is partially true, but not completely. Good deals appear on the MLS regularly, but they get snatched up within hours. You need an agent who understands investment criteria and sends you listings the moment they appear. Set up auto alerts for properties meeting your criteria. When something interesting pops up, analyze it immediately and make an offer within hours if the numbers work. Speed is everything. The key is having clear criteria. Tell your agent exactly what you want. Property type, location, price range, minimum lot size, whatever matters. The more specific you are, the better they can filter for you. Many investors find their first deals on the MLS simply by moving faster than the competition. While others are scheduling showings for next week, you're making offers today. Strategy 2. Direct mail marketing. This is reaching out directly to property owners who might be motivated to sell. You send letters or postcards to targeted lists, offering to buy their properties. The lists might include out-of-state owners, inherited properties, properties with tax liens, properties owned for many years, properties in specific neighborhoods, or properties identified through public records research. Direct mail has lower response rates, maybe 1 to 2%, but the leads you get are often motivated sellers willing to accept below market prices. A typical campaign might involve sending 1,000 letters per month at 50 cents each. That's $500 monthly for 10 to 20 responses and maybe one deal every few months. The messaging matters. You're not trying to convince people to sell. You're finding people who already want to sell and making it easy for them. Your message should be simple. I buy houses. If you're thinking of selling, call me. Strategy 3. Driving for dollars. This old school method still works. Drive through neighborhoods looking for distressed properties, overgrown yards, boarded windows, obvious deferred maintenance. These signal owners who might be motivated to sell. When you find a property, look up the owner through county records and send a letter or knock on the door if appropriate. Many of the best deals come from properties that aren't listed anywhere. The advantage of driving for dollars is you're seeing things before other investors. The disadvantage is it's time-consuming, but if you're willing to put in the work, you'll find opportunities. Strategy 4. Networking. Build relationships with people who know about deals before they're listed. real estate agents, wholesalers, other investors, contractors, property managers, attorneys, and accountants. Join local real estate investor associations, attend meetups, connect with people on Facebook groups and online forums. Let everyone know you're actively buying. Many investors get their best deals from referrals. Someone knows someone who needs to sell quickly, and because you've built a relationship, they think of you. Networking takes time to produce results, but it's cumulative. Each person you meet expands your network. Eventually, deals start coming to you instead of you chasing them. Strategy 5. Auctions. Foreclosure auctions and tax lien sales can provide below-market properties, but they're risky because you often can't inspect properties before buying and you need cash immediately. Auctions work best for experienced investors who can quickly assess property values and have capital ready to deploy. For beginners, auctions are generally too risky. Strategy 6. Working with wholesalers. Wholesalers find below-market properties and sell the contracts to investors. You pay the wholesale fee, but get a property you might not have found yourself. The challenge is finding good wholesalers. Many are inexperienced and bring terrible deals, but if you find a skilled wholesaler who understands your criteria, they can be a valuable source of deals. Build relationships with several wholesalers. Make it clear what you're looking for and that you can close quickly if they bring good deals. Over time, they'll prioritize you when they find something matching your criteria. The key to finding deals is consistency. You can't search for a week, find nothing, and give up. Finding deals is a numbers game. The more properties you analyze, the more offers you make, the more likely you are to get deals accepted. Set a goal. Analyze 5 properties per week, make 2 offers per week. Do this consistently for 6 months, and you'll almost certainly get deals accepted. Most beginners quit before they've given the process enough time to work. Chapter 6. How to analyze properties. Like a professional, finding potential deals is only half the battle. The critical skill is analyzing properties to determine if they're actually good investments. This is where most beginners fail. They either overestimate income, underestimate expenses, or simply don't know what metrics to track. Let me walk you through the exact analysis process professional investors use. Master this, and you'll avoid the expensive mistakes that bankrupt beginners. The 50% rule. Before we dive into detailed analysis, let me give you a quick screening tool. The 50% rule. This states that operating expenses on rental properties typically run about 50% of gross rental income. If a property rents for $2,000 per month, expect about $1,000 in expenses, excluding the mortgage. This includes property taxes, insurance, maintenance, repairs, vacancy, property management, and capital expenditures. The 50% rule isn't exact, but it's a fast way to screen deals. If the remaining 50% doesn't cover the mortgage payment, plus leave some profit, the deal probably doesn't work. Example, a property rents for $24,000 annually. 50%, $12,000, goes to expenses. If the mortgage is $15,000 annually, you're losing $3,000 per year. Walk away. The 50% rule helps you reject bad deals quickly without wasting time on detailed analysis. Only when a property passes this initial screen do you dig deeper. The detailed analysis process. For properties that pass the 50% rule, here's the comprehensive analysis framework. Step 1. Determine gross rental income. What will the property rent for? Don't guess. Research actual rents for comparable properties in the same area. Use Zillow, Rentometer, local classifieds, and call property managers to ask what similar properties rent for. You want at least 3 comparable rentals to establish a range. Be conservative, use the lower end of the range or slightly below it. Overestimating rent by even $100 per month can make a bad deal look good on paper. Also consider whether current rent is market rate. If the property is currently rented for $1,500 but market is $1,800, you can't immediately increase to market. Factor in turnover time and the risk that the current tenant might leave when you raise rent. Step 2. Calculate operating expenses. This is where beginners make the costliest mistakes. They underestimate expenses, often dramatically. Let's break down each category. Property taxes. Get the exact annual amount from county records. Don't assume it won't increase. In many markets, property taxes rise when properties sell. Call the county assessor and ask what taxes will be after you purchase. Insurance. Get actual quotes from insurance agents. Don't estimate. Insurance costs vary wildly based on location, property age, and coverage type. Landlord insurance is more expensive than homeowner insurance because it covers additional risks. Maintenance and repairs. Budget at least 1% of property value annually. On a $200,000 property, that's $2,000 per year, or $167 per month. Some years you'll spend less, some years much more. Over time, it averages out. Maintenance includes routine items, HVAC servicing, gutter cleaning, pest control, lawn care. Repairs are unexpected issues, water heaters failing, pipes leaking, appliances breaking. Vacancy. Budget for at least 5 to 10% vacancy even in strong rental markets. Properties sit empty between tenants. Sometimes tenants don't pay rent and you're going through eviction. On $2,000 monthly rent, 5% vacancy is $100 per month or $1,200 annually. This is money you don't collect but need to account for. Property management. Even if you plan to self-manage initially, include this expense in your analysis. You might decide to hire management later, or you might need to sell, and buyers will calculate based on managed expenses. Property managers typically charge 8 to 12% of rent. On $2,000 monthly rent, 10% is $200. Self-managing saves money but costs time. As your portfolio grows, professional management becomes necessary. Build it into your numbers from the start. Capital expenditures. CapEx. This is money set aside for major replacements, roofs, HVAC systems, water heaters, appliances, flooring, driveways. These don't happen monthly, but they're inevitable. A roof might last 20 years, but when it needs replacement, it costs $10,000 to $20,000. You need reserves. A common approach is budgeting based on component lifespans. Roof, $20,000 every 25 years equals $67 monthly. HVAC, $5,000 every 15 years equals $28 monthly. Water heater, $1,000 every 10 years equals $8 monthly. Appliances, $3,000 every 10 years equals $25 monthly. Flooring, $5,000 every 15 years equals $28 monthly. Total CapEx reserve, $156 monthly. Many beginners skip CapEx entirely, which is financial suicide. When the roof needs replacement and you have no reserves, you're either taking on expensive debt or selling at a loss. Utilities. Determine which utilities you'll pay versus tenants. In single-family rentals, tenants usually pay everything. In multifamily, you might pay water, sewer, trash, or common area electricity. Get actual costs from the seller or utility companies. Don't estimate HOA fees. If the property is in an HOA, include monthly fees. These can be substantial and typically increase annually. Other expenses. Depending on the property, you might have additional costs. Snow removal, landscaping, pest control, legal fees, accounting fees. Add up all these expenses. If they're not at least 40 to 50% of gross rent, you're probably missing something or in an unusually low expense market. Step 3. Calculate net operating income, NOI. Net operating income is gross rental income minus operating expenses, excluding mortgage payment. Example, gross rental income, $24,000 annually. Operating expenses, $12,000 annually. NOI, $12,000 annually. NOI tells you what the property generates before debt service. This is crucial for comparing properties and calculating key metrics. Step 4. Calculate cash flow. Cash flow is what's left after paying the mortgage. Using the example above, NOI, $12,000 annually. Annual mortgage payment, $9,600, $800 monthly. Cash flow, $2,400 annually, $200 monthly. Positive cash flow means the property pays you every month. Negative cash flow means you're paying to own it, which is acceptable only if you have strong appreciation expectations. Most investors require at least $100 to $200 monthly cash flow per property minimum. This provides a buffer for unexpected expenses. Step 5. Calculate cash-on-cash return. Cash-on-cash return is annual cash flow divided by total cash invested. Example, annual cash flow, $2,400. Total cash, invested, $50,000. Down payment plus closing costs. Cash-on-cash return, 4.8%. This tells you what return you're getting on your actual money invested. Stock markets average 7 to 10% long-term, so you want cash-on-cash returns above that, to justify the additional work and risk of real estate. Target minimum, 8% cash-on-cash return, ideally 10 to 15%. If a property only returns 4 or 5%, it's probably not worth the effort unless you have strong appreciation expectations or other strategic reasons. Step 6. Calculate cap rate. Capitalization rate is NOI divided by property value. It measures the property's return independent of financing. Example, NOI $12,000, property value $200,000, cap rate 6%. Cap rates vary by market. In expensive coastal cities, cap rates might be 3 to 4%. In lower cost markets, 6 to 9% is common. Cap rates help you compare properties across different price points and markets. A higher cap rate generally means better value, though it often correlates with lower quality areas. Cap rates also indicate market sentiment. Declining cap rates mean prices are rising faster than rents. Rising cap rates mean rents are growing faster than prices or prices are falling. Step 7. Calculate total return. Remember the 4 profit centers. Let's add them all up to see total annual return. Cash flow, $2,400. Appreciation, 3% of $200,000, $6,000. Loan paydown, estimated, $3,000. Tax savings, estimated, $2,000. Total annual return, $13,400 on $50,000 invested equals 26.8% total return. This is why real estate is so powerful. Even a mediocre property can deliver 20 to 30% total returns when you include all profit centers. Step 8. Stress test the deal. Before committing, run pessimistic scenarios. What if rent is 10% lower than projected? What if expenses run 60% instead of 50%? What if the property sits vacant for 3 months? What if major repairs happen in year 1? If the deal still works under pessimistic assumptions, it's probably solid. If it only works with optimistic assumptions, it's too risky. Red flags, that signal bad deals. Certain warning signs indicate you should walk away, regardless of what the numbers say. Red flag 1, seller won't provide financial records. If the seller refuses to show rent rolls, expense records, or tax returns, assume they're hiding problems. Legitimate sellers with profitable properties have no reason to conceal information. Red flag 2, the property has been listed for months. Properties that sit on the market for extended periods usually have issues. Either they're overpriced or there are problems other investors have identified. Red flag 3, deferred maintenance is obvious. If the property shows clear signs of neglect, peeling paint, damaged roofs, foundation cracks, the required repairs will exceed your estimates. Deferred maintenance compounds, one problem leads to others. Red flag 4, the neighborhood is declining. Check crime statistics, school ratings, employment data, and population trends. Neighborhoods in decline face falling rents and rising vacancies. Even if the current numbers work, future prospects are poor. Red flag 5, the deal seems too good. If numbers look dramatically better than comparable properties, something is wrong. Maybe the seller is lying about rent. Maybe there are hidden problems. Maybe it's in a terrible location. Trust your instincts. Deals that seem too good to be true usually are. Common analysis, mistakes, beginners. Let me save you from the painful lessons I learned. Mistake 1, using gross yield instead of net yield. Gross yield is annual rent divided by purchase price. It's a useless metric because it ignores expenses. A property with 12% gross yield and 60% expenses performs worse than one with 8% gross yield and 40% expenses. Always analyze net yields after expenses. Mistake 2, forgetting closing costs. Your cash invested isn't just the down payment. Include closing costs, typically 2 to 4% of purchase price, inspection fees, appraisal fees, and initial repairs or improvements. These costs reduce your cash-on-cash return significantly. Mistake 3, assuming perfect occupancy. No property maintains 100% occupancy forever. Tenants move. Properties need repairs between tenants. Sometimes tenants don't pay. Budget for at least 5% vacancy, preferably 10%. Mistake 4, ignoring future rent growth. While you should be conservative in year one projections, consider rent growth over time. In most markets, rents increase 2 to 4% annually. A property with marginal cash flow initially might become very profitable in 5 years as rents rise while the mortgage payment stays fixed. Mistake 5. Forgetting about taxes. Rental income is taxable. Your actual return after taxes is lower than pre-tax returns. However, depreciation and deductions often offset much of the income. Consult a tax professional to understand your specific situation, but generally assume you'll pay taxes on about 50% of your cash flow after depreciation. Tools that make analysis easier. Don't analyze properties manually. Use tools that automate calculations. Spreadsheets. Create a template with all the formulas built in. Input property details and let the spreadsheet calculate all metrics. Many investors share templates online for free. Real estate analysis, software, tools like DealCheck, REI Blackbook, or Rentometer Pro streamline property analysis and help you compare multiple properties quickly. Financial calculators, use online calculators for mortgage payments, cash-on-cash returns, and cap rates. Don't rely on mental math for six-figure decisions. The key is having a consistent analysis process. Use the same template for every property so you can compare apples to apples. Chapter 7. Making offers that get accepted. You've found a property, analyzed it, and determined it meets your criteria. Now you need to get it under contract. This is where negotiation skills separate successful investors from everyone else. Understanding seller motivation. Not all sellers are equally motivated. Understanding why someone is selling helps you craft winning offers. Motivated seller categories. Divorce. Couples divorcing often need to sell quickly to divide assets. They may accept below-market prices for speed and certainty. Inheritance. People who inherit properties they don't want often sell below market to avoid the hassle of being landlords. Financial distress. Sellers facing foreclosure, job loss, or other financial problems may need quick sales and accept lower prices. Relocation. People moving for work often can't wait for top dollar. They need to sell before leaving. Tired landlords. Landlords burned out from tenant problems, maintenance, or management may sell below market to be done with it. Downsizing. Elderly sellers or empty nesters might prioritize simple, fast transactions over maximum price. When you identify motivation, tailor your offer accordingly. Motivated sellers care about speed, certainty, and simplicity as much as price. The offer strategy. Your first offer is rarely your best offer. Start lower than you're willing to pay, leaving room for negotiation. How much lower? It depends on market conditions and seller motivation. In hot markets with multiple offers, lowball offers get ignored. Start at 90 to 95% of asking price. In normal markets with motivated sellers, start at 70 to 80% of asking price. In distressed situations, start at 50 to 70% of asking price. Include a personal letter explaining why you want the property. Sellers often accept lower offers from buyers they like or who seem like good fits. Offer terms that matter beyond price. Price isn't the only negotiable element. Consider these terms. Closing timeline. Offer flexibility on closing dates. If the seller needs to close quickly, accommodate that. If they need time to find a new place, give them that. Contingencies. Fewer contingencies make offers more attractive. If you can waive inspection contingencies or appraisal contingencies, your offer becomes more competitive. Be careful waiving contingencies, though. They protect you from problems. Only waive them if you're experienced enough to assess risks. Earnest money. Larger earnest money deposits show you're serious. In competitive situations, putting down 5 to 10% as earnest money can win deals. Rent-back agreements. Offer to let sellers rent the property after closing if they need. Time to move. This costs you little but provides them flexibility. Including personal property, sometimes including furniture, appliances, or other items, sweetens the deal without costing much. Handling counteroffers. Most sellers counter initial offers. Don't take it personally, it's negotiation. When you receive a counter, assess whether the new terms work for your numbers. If the seller counters at a price where the deal no longer makes sense, walk away. Never get emotionally attached to properties. There are always more deals. Don't overpay because you fell in love with a house. If the counter is close to your limit, make one more offer, splitting the difference or with a slight increase. Most negotiations resolve within 2 or 3 rounds. The walkaway strategy. Sometimes the best negotiation tactic is walking away. If you can't reach terms that work for your analysis, thank the seller and move on. Often, sellers come back days or weeks later ready to accept your terms because other offers fell through or they realized your offer was fair. Walking away demonstrates you're serious about your numbers and not desperate. Desperation is expensive in real estate. Part 3. Financing your real estate investments. Chapter 8. Traditional financing options. How you finance properties dramatically affects your returns and scalability. Understanding your options is crucial. Conventional mortgages. These are standard mortgages from banks and lenders. For investment properties, expect 25% down payment minimum, sometimes 20%. Interest rates 0.5 to 1% higher than owner-occupied rates. Stricter qualification requirements. Limits on number of financed properties, typically 4 to 10. Conventional financing works for most investors starting out. Rates are competitive and terms are standardized. The challenge is qualifying for multiple mortgages as you scale. Lenders count existing mortgage payments against your debt-to-income ratio, limiting how many properties you can finance. FHA loans. Federal Housing Administration loans require as little as 3.5% down, but only work for owner-occupied properties. This is perfect for house hacking. FHA loans allow you to buy duplexes, triplexes, or fourplexes with minimal down payment as long as you live in one unit. After living there for a year, you can move out, rent your unit, and buy another property with a new FHA loan. This strategy allows investors to acquire multiple properties with minimal capital over several years. Portfolio loans. Portfolio loans come from banks that keep the loans on their books rather than selling them. This gives them flexibility on terms. Portfolio lenders may allow more than 10 financed properties, offer creative terms, consider rental income more favorably, work with self-employed borrowers. The trade-off is typically higher interest rates and shorter terms, 15 or 20 years, instead of 30. As you scale beyond 4 or 5 properties, portfolio lenders become essential. Commercial loans. Properties with 5 or more units are considered commercial real estate and require commercial financing. Commercial loans differ from residential, based on property performance, not personal income, shorter terms, 5, 7, or 10 years with balloons, higher interest rates, larger down payments, 25 to 35%. Commercial loans evaluate the property's ability to repay the loan, making them easier to qualify for if the property cash flows well, but harder if it doesn't. Seller financing. Sometimes sellers will finance your purchase, essentially acting as the bank. You make payments to them instead of a traditional lender. Seller financing can offer lower down payments, flexible terms, easier qualification, faster closing. The catch is finding sellers willing to do it. Sellers who own properties free and clear are best. Candidates. Propose seller financing as an option, especially if you're offering close to asking price. Frame it as beneficial to them. Steady monthly income, higher total price, tax advantages of installment sales. Hard money and private money. Hard money lenders are companies that loan based on property value, not borrower qualifications. They charge high interest, 8 to 12%, and fees, but fund quickly. Hard money works for flips and BRRRR deals where you'll refinance out within months. The high cost is acceptable for short-term financing. Private money comes from individuals, friends, family, other investors who loan you money for investments. Terms are negotiable. Building relationships with private lenders takes time but provides flexible capital for deals. Creative financing strategies. Beyond traditional options, creative strategies can help you acquire properties. Subject to taking over existing financing, subject to the current mortgage. The deed transfers to you, but the original loan stays in the seller's name. This is risky for sellers and legally complex. Use experienced attorneys if attempting. Lease options. Leasing a property with the option to purchase later. This gives you control with minimal capital. Partnerships. Partnering with someone who has capital while you contribute skills and work. Split profits according to contribution. Partnerships allow you to do deals without capital initially, though you give up some profits and control. Chapter 9: How to qualify for investment property loans. Getting approved for investment property loans is harder than owner-occupied mortgages. Lenders scrutinize your finances carefully. Credit score requirements. Expect lenders to want 680+ credit scores for investment properties. Below that, you'll struggle to get approved or face very high rates. If your credit is below 680, focus on improving it before trying to invest. Pay down credit cards, fix errors on credit reports, and avoid new credit inquiries. A credit score of 740+ gets you the best rates, potentially saving tens of thousands over a loan's life. Income documentation. Lenders want to see stable income from employment or business. W-2 employees have easier qualification than self-employed borrowers. Self-employed individuals need 2 years of tax returns showing consistent or increasing income. If your income varies dramatically, lenders get nervous. The frustrating part for real estate investors: rental income from investment properties you don't yet own can't be counted toward qualification for your first property. You need sufficient income from other sources. After owning a rental for 2 years, lenders will count 75% of the rent as income for qualifying for additional properties. Debt-to-income ratio. Lenders calculate DTI by dividing monthly debt payments by gross monthly income. Most want DTI below 43% for investment properties. Include in debt, mortgage payments, car loans, student loans, credit card minimums, other debt obligations. If your DTI is too high, you have 2 options: increase income or pay down debt before applying. Down payment and reserves. You need documented down payment funds. Lenders want to see money has been in your accounts for at least 2 months. Recent large deposits raise red flags. If you deposited $20,000 last week, lenders will ask where it came from and require documentation. Additionally, lenders want to see reserves, usually 3 to 6 months of mortgage payments, in your accounts after closing. This ensures you can handle vacancies or repairs. Multiple properties. Each additional property makes qualifying for the next one harder because lenders count mortgage payments against your DTI. However, after 2 years, they'll count 75% of rental income, which helps offset the payments. Scaling to 10 or more. Properties typically require switching to portfolio lenders or commercial loans with different qualification criteria, improving your qualification profile. If you don't currently qualify, work on these areas. Improve credit score to 740+. Increase income through raises, side businesses, or partner income. Pay down credit cards and other debts. Save larger down payment and reserves. Reduce expenses to improve DT. Getting approved is about demonstrating to lenders that you're low risk. The stronger your financial profile, the better terms you'll receive. Part 4: Managing your investment properties. Chapter 10: Finding and managing tenants. You've bought a property. Congratulations. Now comes the part that determines whether you actually make money finding good tenants and managing them effectively. This is where real estate investing stops being theoretical and becomes very real. Bad tenants can turn a great property into a nightmare. Good tenants make real estate feel like passive income. The tenant screening process. Never ever skip proper tenant screening. I don't care how nice someone seems or how desperate you are to fill the vacancy. Follow a systematic process every single time. Step 1. The application require every prospective tenant to complete a full written application including full legal name and date of birth, current address and previous addresses for 3 years, current employer and previous employers, monthly income with documentation, references from previous landlords, emergency contacts, vehicle information, pet information, charge an application fee, typically $30 to $50, to cover background check costs and ensure applicants are serious. Step 2. Income verification. Require proof of income, recent pay stubs, bank statements, or tax returns. The general rule is tenants should earn at least 3 times monthly rent. On a $1,500 rental, tenants should document $4,500 monthly income minimum. This ensures they can afford rent plus other living expenses. Call employers to verify employment and income. Some applicants fake pay stubs or borrow someone else's. A quick phone call confirms reality. Step 3. Credit check. Run a full credit report. You're looking for credit score, ideally 600 plus, payment history on other obligations, outstanding debts, collections or judgments, previous evictions. A low credit score isn't automatic disqualification, but it requires explanation. Did they have medical debt? Went through divorce? These are different from chronic irresponsibility. Previous evictions are major red flags. Someone evicted before will likely be evicted again. Walk away. Step 4. Criminal background check. Run a criminal background check. You need to know if applicants have violent crimes, theft, fraud, or drug-related convictions. You can't discriminate based on arrests without convictions, but convictions, especially recent ones, are legitimate concerns. Some landlords won't rent to anyone with any criminal record. Others evaluate case by case, decide your policy in advance, and apply it consistently. Step 5. Landlord references. Call previous landlords, not just the current one. Current landlords might give good references just to get rid of bad tenants. Ask previous landlords. Did the tenant pay rent on time? Did they maintain the property? Were there noise complaints or issues with neighbors? Did they give proper notice when moving? Would you rent to them again? That last question is crucial. If a previous landlord hesitates or says no, that tells you everything. Step 6. The interview meet applicants in person at the property. This lets you assess their professionalism, communication skills, and whether they seem like they'll be good tenants. Red flags during interviews: showing up late without calling, bringing uninvited guests, asking to move in immediately without going through the process, offering to pay extra to skip the background check, making excuses for every negative item before you've even asked. Trust your instincts. If something feels off, it probably is. The fair housing laws you must follow. Federal law prohibits discrimination based on race, color, national origin, religion, sex, familial status, or disability. Many states add additional protected classes. You must apply screening criteria consistently to all applicants. You can't approve one person with a 580 credit score while rejecting another with a 590 credit score based on protected class status. Document everything. Keep copies of all applications, screening reports, and communications. If you're ever accused of discrimination, documentation proves you applied criteria fairly. What you can legally reject applicants for: insufficient income, poor credit history, negative landlord references, criminal convictions, with some limitations, pets, unless they're service or support animals, smoking, you can have smoke-free properties, consult an attorney familiar with your state's fair housing laws before rejecting applicants for any reason. Discrimination lawsuits are expensive even if you win. Setting the right rent price: charge market rent, not what you need to cash flow. The market determines rent, not your mortgage payment. Research comparable rentals extensively. Look at properties with similar size, bedrooms, bathrooms, square footage, location, same neighborhood or nearby, condition, comparable quality and amenities, lease terms, month-to-month versus annual leases. Visit competitor properties posing as a prospective tenant. See what you're competing against. If other rentals offer in-unit laundry and yours doesn't, expect to charge less. Consider hiring a property manager for a consultation, even if you plan to self-manage. They know local markets and can advise on competitive pricing. Price slightly below market initially to attract more applicants. Having 10 qualified applicants lets you choose the best. Having one forces you to accept whoever applies. The lease agreement: use a comprehensive lease agreement covering every possible scenario. Don't create your own unless you're an attorney. Use state-specific lease templates from landlord associations or attorneys. Your lease should specify rent amount and due date, late fees and grace periods, security deposit amount and terms, tenant responsibilities for utilities, property maintenance responsibilities, guest and occupancy policies, pet policies, smoking policies, entry notice requirements, lease renewal and termination procedures, consequences for lease violations. The lease protects both you and the tenant by making expectations clear. Ambiguity leads to disputes. Have tenants initial every page and sign the final page. Keep copies in a safe location. You'll need them if disputes arise. Security deposits: collect security deposits equal to 1 month's rent or your state maximum. This provides funds for damage repairs when tenants move out. Security deposits are tenant money held in trust. Many states require keeping deposits in separate bank accounts and paying interest. Document property condition thoroughly at move-in with photos or video. Walk through with tenants noting existing damage. Have them sign acknowledging condition. When tenants move out, conduct another walkthrough, photograph everything, and document any damage. This protects you from disputes about deposit deductions. Return deposits within your state's required time frame, often 14 to 30 days, with an itemized list of any deductions. Keep receipts for repairs. Disputes over security deposits are among the most common landlord-tenant conflicts. Meticulous documentation prevents most problems. Chapter 11. Ongoing property management. Once you have tenants in place, the real work begins. Successful property management separates profitable investments from money pits. Collecting rent. Establish clear rent collection procedures from day one. Set automatic payments if possible. Use services like Pay Near Me, Zelle, or specialized landlord software that automates collection. If tenants pay manually, specify the exact due date, first of the month is standard, and late fee policy. Enforce late fees consistently. If your lease says rent is due on the 1st with a 5-day grace period and late fees afterward, charge late fees on day 6 without exception. Being lenient once creates expectations. Tenants will push boundaries if you allow it. If rent is late, send a written notice immediately. Don't wait hoping they'll remember. Document everything. If rent is more than a week late, call the tenant. Find out what's happening. Are they having temporary financial problems, or are they becoming unreliable? If rent is 2 weeks late, begin eviction proceedings. This sounds harsh, but you're running a business, not a charity. Tenants who can't pay rent need to leave, so you can find tenants who can. Never accept partial payments without a written agreement. If you accept half the rent, you may legally be unable to evict for non-payment until the next month. Maintenance and repairs. You're responsible for maintaining the property in habitable condition. This means functioning plumbing, electricity, heating, structural integrity, and safety. Establish a system for maintenance requests. Provide tenants with multiple contact methods, phone, email, online portal. Make it easy for them to report issues. Respond quickly. Even if you can't fix something immediately, acknowledge the request within 24 hours. Categorize urgency, emergency, no heat in winter, major leaks, no electricity. Fix within hours, urgent, broken appliances, minor leaks, pest problems. Fix within 1 to 3 days, routine, cosmetic issues, minor repairs. Fix within 1 to 2 weeks for emergencies. Have contractors on call who will respond immediately. Yes, they charge more for emergency service. That's the cost of being a landlord. For routine issues, batch repairs to save money. If you're fixing one thing, see if other minor items need attention. Keep detailed maintenance logs. Track what was fixed, when, and cost. This helps with budgeting and proves you maintain properties properly. Dealing with difficult tenants. Even with great screening, you'll eventually deal with problem tenants. How you handle them determines whether issues become catastrophes. Late rent. Follow your lease enforcement procedure exactly. Don't make exceptions. Start eviction proceedings when your lease specifies. Noise complaints. Document complaints. Talk to tenants about the issue. Send written warnings if it continues. Multiple violations may justify eviction. Property damage. Small wear and tear is expected. Significant damage beyond normal use should be addressed immediately with tenants responsible for costs. Lease violations. Whether it's unauthorized occupants, pets, or smoking, enforce your lease. Send written notices, give tenants opportunity to correct, then proceed with eviction if they don't comply. Communication issues. Some tenants constantly complain or make unreasonable demands. Respond professionally, document everything, but don't let them abuse your time. The key is documentation. Keep records of every interaction, every complaint, every repair request, and every payment. If you end up in court, documentation proves your case, the eviction process. Eventually, you'll need to evict someone. It's unpleasant but necessary. Understanding the process is critical. Eviction laws vary dramatically by state and even city. Some jurisdictions are extremely landlord-friendly with quick processes, others are tenant-friendly with lengthy procedures. Research your local laws or consult an attorney before attempting eviction. General process: 1. Tenant violates lease, usually non-payment. 2. Send written notice giving them opportunity to fix the violation or move. 3. If they don't comply, file eviction lawsuit in court. 4. Attend court hearing. 5. If you win, receive judgment and writ of possession. 6. Sheriff physically removes tenant if they don't leave voluntarily. Timelines vary from a few weeks to many months depending on location. Never attempt self-help eviction, changing locks, removing possessions, shutting off utilities. These are illegal and can result in you being sued and fined. Always go through proper legal channels, even though it's frustrating and expensive. Chapter 12. Should you self-manage or hire a property manager? This is one of the biggest decisions you'll make. The answer depends on your situation, skills, and goals. Self-management advantages: cost savings. Property managers typically charge 8 to 12% of rent. On $2,000 monthly rent, that's $160 to $240 per month, or $1,920 to $2,880 annually. Self-managing saves this money. Direct control. You make all decisions about tenant selection, maintenance, rent pricing, and property improvements. No intermediaries. Better understanding. Managing yourself forces you to learn the business deeply. This knowledge is valuable as you scale. Tenant relationships. Direct relationships with tenants can lead to better communication and fewer issues. Self-management. Disadvantages: time commitment. Expect 5 to 10 hours monthly per property for showing units, collecting rent, handling maintenance, dealing with tenant issues. Availability requirements. Tenants expect relatively quick responses. If you travel frequently or work unpredictable hours, self-management is challenging. Emotional stress. Dealing with difficult tenants, late-night emergencies, and evictions is stressful. Some people handle it well, others don't. Legal risk. Property managers know. Landlord-tenant law. Most landlords don't. Mistakes can be expensive. Scalability limits. You can probably self-manage 5 to 10 properties maximum before it becomes overwhelming. Growth requires hiring help eventually. Property management advantages: time freedom. Managers handle everything: marketing, showing units, screening tenants, collecting rent, coordinating repairs, handling emergencies. Professional expertise. Good managers know laws, market rents, contractor networks, and best practices. Scalability. Managers allow you to own 20, 50, or 100 plus properties without the work consuming your life. Distance investing. Managers make owning out-of-state or out-of-country properties possible. Better tenant management. Professional managers often screen better, enforce rules more consistently, and handle difficult situations more effectively. Property management disadvantages. Cost. That 8 to 12% significantly impacts cash flow, especially on tighter margins. Loss of control. You're trusting someone else with your asset. Bad managers can damage your property and finances. Communication gaps. Information doesn't always flow smoothly. You might not hear about problems until they're serious. Variable quality. Management quality varies wildly. Finding good managers takes effort and luck. My recommendation: self-manage your first property or two. Learn the business, understand what's involved, and build skills. As you acquire more properties or your life gets busier, transition to professional management. The time freedom and scalability are worth the cost once you have multiple properties. Interview multiple property managers, ask for references, tour properties they manage, review their management agreements carefully. Expect to pay 8 to 10% for single-family homes, sometimes less for multi-family properties where economies of scale reduce their workload per unit. Good managers are worth every penny. Bad managers are expensive disasters. Choose carefully. Part 5. Advanced Strategies and Scaling. Chapter 13. Building a multi-property portfolio. Owning one rental property is nice. Owning 10 is life-changing. Let's talk about scaling from your first property to a substantial portfolio. The scaling timeline. Realistic expectations. Most investors acquire 1 to 2 properties per year initially. This seems slow, but it compounds. Year 1. Buy first property, house hack or rental. Year 2. Buy second property. Year 3. Buy third and fourth properties. Year 4. Buy fifth and sixth properties. Year 5. Own 6+ properties generating significant cash flow. By year 5, you might have $3,000 to $4,000 monthly cash flow. By year 10, you could have $8,000 to $10,000 monthly cash flow, effectively replacing most people's jobs. The key is consistency. One property per year for 20 years is 20 properties, a portfolio generating potentially $10,000 to $15,000 monthly cash flow. How to accelerate acquisition. If you want to scale faster, several strategies help. Strategy 1. Use BRRRR to recycle capital. Instead of leaving money in each property, use BRRRR to pull capital out and redeploy it. This lets you acquire multiple properties with the same initial capital. Strategy 2. Partner on deals. Partnerships allow doing bigger or more deals than you could solo. You might contribute skills while a partner contributes capital, or split both contributions. Common partnership structures: 50-50, equal capital and work contributions, 70-30, one partner provides most capital, other does most work. Syndication, you find and manage deals. Multiple passive investors provide capital. Partnerships can accelerate growth dramatically, but require compatible partners and clear agreements. Use attorneys to draft partnership agreements specifying everyone's roles, contributions, profit splits, and exit strategies. Strategy 3. Commercial multifamily buying. A 20-unit apartment building adds 20 rental units in one transaction versus buying 20 separate single-family homes. Commercial multifamily requires different skills, larger capital, and commercial financing, but it's the fastest way to scale once you're ready. Strategy 4. Leverage home equity. As your properties appreciate, you build equity. Use home equity lines of credit, HELOCs, or cash-out refinances to access this equity for additional down payments. Example: your first property appreciated from $250,000 to $325,000 over 5 years. You refinance, pull out $50,000 in equity, and use it for down payments on 2 more properties. Strategy 5. Seller financing at scale. As you become more experienced, you can structure creative deals using seller financing, master leases, or other techniques requiring minimal capital. The Portfolio Management Challenge. The more properties you own, the more complex management becomes. Systems and processes become critical. Build standard operating procedures. Document everything. Tenant screening criteria, lease templates, maintenance procedures, contractor lists, rent collection processes. When you know exactly how to handle every situation, management becomes systematic rather than reactive. Use technology. Property management software like Buildium, Appfolio, or Rent Ready automates rent collection, maintenance requests, and communication. Use cloud storage for all documents so you can access them anywhere. Use digital signatures for leases and agreements. Delegate and outsource. As you scale beyond 5 to 10 properties, you can't do everything yourself. Hire help. Virtual assistants for administrative tasks, contractors for repairs and maintenance, property managers for day-to-day operations, bookkeepers for financial records, attorneys for legal issues. The income from 10+ properties supports a small team that frees your time while growing the business. Chapter 14. Tax. Strategies for real estate investors. Real estate offers tax advantages that can dramatically increase your actual returns. Understanding and using these strategies is crucial. Disclaimer: I'm not a tax professional. Consult a CPA or tax attorney for advice specific to your situation. This is educational information, not tax advice. Depreciation, the magic tax deduction. Depreciation is the most powerful tax benefit in real estate. The IRS lets you deduct the theoretical decline in your property's value, even though it's probably increasing. Residential real estate depreciates over 27.5 years. Divide your property's value, excluding land, by 27.5 to get annual depreciation. Example: $300,000 property, land worth $50,000, building worth $250,000. Annual depreciation: $250,000 divided by 27.5 equals $9,091. $9,091 is a paper loss you can deduct against your rental income. If the property generates $12,000 in net income, depreciation reduces your taxable income to $2,909. Even better, if you're a real estate professional, spending 750+ hours annually in real estate and it's your primary occupation, You can deduct real estate losses against all income, not just rental income. Cost segregation. Cost segregation is an advanced strategy that accelerates depreciation by separating property components depreciating at different rates. Instead of depreciating everything over 27.5 years, a cost segregation study identifies components depreciating faster: appliances, carpets, flooring, 5 years, landscaping, sidewalks, 15 years, building structure, 27.5 years. This front-loads depreciation deductions, creating massive tax savings in early years. Cost segregation studies cost $5,000 to $15,000, so they make sense on properties worth $500,000 plus. 1031 exchange, deferring capital gains. When you sell investment property, you owe capital gains tax on the profit. A 1031 exchange lets you defer this tax by buying another investment property. Rules are strict. Must identify replacement property within 45 days of selling. Must close on replacement property within 180 days. Must use a qualified intermediary. Can't touch the sale proceeds. Replacement property must be equal or greater value. Done correctly, you can sell properties, buy bigger ones, and never pay capital gains tax. When you eventually die, your heirs receive stepped-up basis and the tax liability disappears entirely. Investors use 1031 exchanges to continually trade up, deferring taxes indefinitely while building larger portfolios. Deductible expenses. Nearly everything related to your rental properties is tax deductible. Mortgage interest, property taxes, insurance, repairs and maintenance, property management fees, legal and professional fees, travel to inspect or manage properties, home office expenses, education and training, advertising and marketing, utilities you pay, HOA fees. Keep meticulous records, every receipt, every expense. Use accounting software to track everything. The $25,000 rental loss exception. Normally, rental losses can only offset rental income, but if you actively participate in managing your rentals and earn less than $100,000, you can deduct up to $25,000 in rental losses against other income. This means if you have a W-2 job earning $75,000 and your rental properties show a $25,000 loss after depreciation, you can reduce your taxable income to $50,000. The deduction phases out between $100,000 to $150,000 in income and disappears above that. Real estate professional status. If you qualify as a real estate professional, 750 plus hours annually in real estate, more than any other occupation, you can deduct unlimited rental losses against all income. This is powerful for high earners. You could make $300,000 from other sources, show $100,000 in rental losses, and only pay tax on $200,000. Qualifying requires careful documentation. Track every hour spent on real estate activities. The IRS scrutinizes real estate professional claims. Opportunity zones. Opportunity zones are designated economically distressed areas where you can defer and reduce capital gains taxes by investing in real estate or businesses. If you invest capital gains in an opportunity zone fund within 180 days, you defer paying capital gains tax until 2026, or when you sell. After 5 years, you reduce taxable capital gains by 10%. After 7 years, you reduce taxable capital gains by 15%. After 10 years, you pay zero capital gains on the Opportunity Zone investment appreciation. This is complex but potentially very valuable for investors with substantial capital gains. Working with tax professionals. Real estate tax strategy is complex. DIY tax preparation leaves money on the table. Hire a CPA specializing in real estate. They'll identify deductions and strategies you'd miss, often saving more than their fees. A good real estate CPA costs $1,000 to $3,000 annually, but can save you $5,000 to $20,000 in taxes. It's a high ROI investment. Chapter 15. Common mistakes that destroy real estate investors. Let me save you from the painful, expensive lessons I and other investors learned the hard way. Mistake 1. Buying in the wrong location. Location determines everything: rent amounts, appreciation potential, vacancy rates, tenant quality, and expenses. Buying in declining neighborhoods because the numbers look good initially is a trap. Rents fall, vacancies rise, tenant quality deteriorates, and properties become unsellable. Do thorough location research, crime rates, school ratings, employment trends, population growth, infrastructure development. Buy in B or C plus neighborhoods minimum. Avoid D neighborhoods even if the numbers look amazing on paper. Mistake 2, underestimating expenses. This kills more investors than any other mistake. Properties that cash flow $300 monthly on paper lose money in reality because expenses were underestimated. Always. Use conservative expense estimates. 50% of rent for operating expenses, plus maintenance reserves, plus vacancy reserves. If you're estimating expenses below 45% of rent, you're probably wrong unless you have substantial data proving otherwise. Mistake 3. Overpaying. Getting emotionally attached and paying too much is common. Remember, your profit is made when you buy, not when you sell. If you overpay by $30,000, you lose that money immediately. No amount of great management recovers it. Walk away from deals that don't meet your numbers. There are always more properties. Mistake 4. Poor tenant screening. Desperation to fill vacancies leads to accepting marginal tenants. Those tenants then don't pay rent, destroy property, or create legal headaches. One bad tenant can cost you $10,000 to $30,000 in lost rent, damages, legal fees, and stress. Never compromise on screening standards. A vacant property is better than one occupied by a terrible tenant. Mistake 5. Insufficient reserves. Having no cash reserves for repairs, vacancies, or emergencies puts you one problem away from financial disaster. When the roof leaks and you have no money to fix it, you're forced to take expensive debt or sell at a loss. Maintain reserves of 3 to 6 months of expenses per property minimum. This cushion lets you handle problems without panic. Mistake 6. Not understanding landlord-tenant law. Ignorance of the law is expensive. Making illegal evictions, violating fair housing, or breaching lease obligations can cost tens of thousands in lawsuits and settlements. Study your state's landlord-tenant laws, join landlord associations, consult attorneys when unsure. Following proper procedures protects you legally and financially. Mistake 7. Trying to do everything yourself. Real estate is not a solo game at scale. Trying to do everything yourself limits growth and increases stress. Build a team. Agents, contractors, property managers, lenders, attorneys, accountants, inspectors. Delegation isn't weakness, it's how you scale. Mistake 8. Analysis, paralysis. Some people research forever but never buy anything. They're waiting for the perfect deal, perfect timing, or perfect knowledge. Perfect doesn't exist. You'll never know everything. Markets are never perfectly positioned. Set clear criteria, educate yourself reasonably, then start making offers. You'll learn more from one property than from reading 100 books. Mistake 9. Ignoring market cycles. Real estate markets are cyclical. Buying at market peaks with the expectation of continued rapid appreciation is risky. Understand where your market is in the cycle. If appreciation has been crazy for years, be cautious about assuming it continues. Buy for cash flow and fundamentals, not speculation on appreciation. Mistake 10. Lifestyle creep. As cash flow increases, resist the temptation to increase spending proportionally. The point of real estate is building wealth, not funding lifestyle inflation. Reinvest profits into more properties. Let compounding work. Enjoy the fruits after you've built substantial passive income, not while you're still building. Part 6. Advanced Investment Techniques. Chapter 16. Creative Deal. Structuring. Once you understand the basics, creative deal structuring opens up opportunities that traditional financing can't touch. These strategies require more knowledge and risk management, but they can help you acquire properties with minimal capital or in situations where conventional financing doesn't work. Subject to financing. Explained, subject to means taking over a property subject to the existing mortgage. The deed transfers to you, but the original loan stays in the seller's name, and you make the payments. Here's how it works. A seller owes $180,000 on a property worth $250,000. They need to sell quickly, but don't have time for a traditional sale. You take the deed and agree to make the $1,400 monthly mortgage payment. The seller walks away, you control the property, and no new financing is needed. The advantages are compelling. You acquire property with minimal cash, just closing costs and maybe some equity to the seller. You bypass traditional loan qualification. You can close quickly since there's no bank approval process, and you get the existing interest rate, which might be lower than current rates. The risks are real though. The due on sale clause in most mortgages technically allows the lender to call the entire loan due when ownership transfers. In practice, lenders rarely enforce this as long as payments are made on time, but it's possible. If the seller files bankruptcy or has liens filed against them after you take over, their creditors could come after the property even though you own it. You're also relying on the seller not sabotaging the loan by claiming identity theft or requesting payoff statements that alert the lender to the transfer. Subject to works best when the seller is highly motivated: foreclosure, divorce, relocation. The existing loan has favorable terms. There's significant equity protecting you. You have an attorney structure the deal properly with insurance and safeguards. Never attempt subject to without experienced legal counsel. The risks of doing it wrong are substantial. Lease. Options. Control without ownership. A lease option gives you the right to lease a property with an option to purchase it later at a predetermined price. You're essentially renting with the ability to buy. The typical structure involves a non-refundable option fee, maybe $5,000 to $15,000, that gives you the right to purchase within a specified time frame, usually 1 to 3 years, at an agreed price. During the lease period, you rent the property, often at slightly above market rates. A portion of your monthly rent might be credited toward the purchase price if you exercise the option. Why would sellers do this? Several reasons. They get higher monthly rent. They get the option fee up front. They have a tenant with ownership interest, so better property care. They can sell in a slow market without price reductions. Tax advantages of installment sales. From your perspective, lease options allow you to control property with minimal capital. You can live in it, rent it out, or improve it. If the property appreciates, you profit when you exercise the option. If it depreciates or you change your mind, you walk away losing only the option fee and any rent premiums. Lease options work particularly well for properties in markets where you expect appreciation but can't currently get traditional financing, or when you want to test a market before committing to purchase. The structure requires careful legal documentation, a separate lease agreement and option agreement, clearly defining terms, responsibilities, and what happens in various scenarios. Master lease agreements. A master lease is when you lease a property from the owner and then sublease it to tenants. You become the middleman, making money on the spread between what you pay the owner and what tenants pay you. Example: an owner has a fourplex but doesn't want to manage it. You master lease it for $4,000 monthly. You find tenants for each unit at $1,200 each, collecting $4,800 monthly. Your profit is $800 monthly, and you never bought the property. This strategy works well for apartment buildings with tired landlords, commercial properties needing repositioning, properties requiring management expertise you have. The key is negotiating favorable terms, long lease periods, 3 to 5+ years, the right to sublease, the right to make improvements, and ideally an option to purchase at a predetermined price. Master leases let you control cash-flowing assets without purchasing them. You're building management experience and cash flow while potentially setting up future purchases. Seller financing deep dive. We touched on seller financing earlier, but let's go deeper because it's one of the most powerful creative strategies. Seller financing means the seller acts as the bank. Instead of getting all their money at closing, they receive a down payment and monthly payments over time. Typical structure: 10 to 20% down payment. Interest rate negotiable, often 4 to 7%. Term of 5 to 30 years. Monthly payments until payoff or balloon. Why would sellers do this? The benefits are substantial. They can sell properties that might not qualify for traditional financing. They earn interest income instead of a lump sum sitting in low-yield accounts. Installment sales allow spreading capital gains over multiple years, reducing annual tax liability. They may get higher sales prices by offering financing. In slow markets, it differentiates their property from competitors. Finding sellers willing to offer financing requires asking. Most won't advertise it, but might consider it when proposed. Best candidates for seller financing: properties owned free and clear, no existing mortgages to pay off, older owners who want steady income, properties in disrepair that won't qualify for traditional loans, sellers in slow markets struggling to get offers. When negotiating seller financing, focus on terms that work for both parties. Maybe you offer asking price in exchange for favorable terms, or you offer higher interest in exchange for lower down payment. The documentation is critical. Use an attorney to draft a promissory note and mortgage or deed of trust securing the loan against the property. Record these documents with the county to protect both parties. Partnerships and syndications. If you lack capital but have skills and time, partnerships unlock deal-making ability. Equity. Partnerships. In an equity partnership, one partner contributes capital, another contributes skills and work. Profits split according to contribution. Common structures. 50-50. Equal. Capital and effort. 70-30. Capital partner gets 70%, working partner gets 30%, 80-20. Capital partner gets 80%, working partner gets 20%. The split depends on relative contributions. If you're finding deals, managing renovations, handling tenants, and doing all the work while the partner just provides money, you deserve a larger split than 20%. Equity partnerships work well for beginners with skills but no money partnering with people who have money but no time. House flips where one partner manages the project. Deals where one partner handles the entire process. Clear agreements are essential. Document who does what, how profits split, what happens if someone wants out, and how to handle disputes. Syndications. Syndications involve raising capital from multiple passive investors to purchase larger properties. You become the sponsor or general partner, finding and managing the deal. Investors become limited partners, providing capital but not involvement in operations. Typical syndication structure. Sponsor finds a $2 million apartment building. Sponsor raises $600,000 from 12 investors contributing $50,000 each. Property generates cash flow and appreciates. Cash flow distributes to investors, maybe 8% annually. After 5 to 7 years, property sells. Investors get their capital back plus profit share. Sponsor gets acquisition fee, management fee, and profit share. Syndications are complex legally. Securities laws apply. You need an attorney and potentially SEC registration depending on how you structure the offering. But syndications allow you to do deals far beyond your personal capital. If you can find and manage a $5 million property and raise the equity, you're operating at a completely different level than buying single-family rentals. Start small, maybe partnering with 2 to 3 investors on a small multifamily. Build track record and relationships. Scale up as you prove competence. Chapter 17. Commercial Real Estate. Investing. Most beginner real estate education focuses on residential properties, single-family homes, duplexes, small multifamily. But commercial real estate offers different opportunities and challenges worth understanding. What qualifies as commercial? In real estate, commercial generally means properties with 5+ residential units, office buildings, retail spaces, industrial warehouses, self-storage facilities, mobile home parks, mixed-use properties. The key distinction is that commercial properties are valued differently than residential. Residential value is based on comparables, what similar properties sold for. Commercial value is based on income, the net operating income the property generates. This is crucial because it means you can force appreciation in commercial real estate by increasing income or decreasing expenses. In residential, you're at the mercy of the market. In commercial, you control value directly. Multifamily, the gateway to commercial. Most investors transition from residential to commercial through small multifamily, 5 to 20 units. Why multifamily is attractive? All units are in one location, making management efficient. One property creates multiple income streams. Vacancy doesn't kill you. If one unit is empty in a 10-unit building, you still have 90% occupancy. Forced appreciation through operational improvements. Easier to hire management than for scattered single-family properties. The challenge is that multifamily requires commercial financing, which is different from residential loans. Commercial loans are based on property performance, not personal income. Shorter terms, 5 to 10 years with balloon payments. Higher interest rates, 0.5 to 2% above residential, larger down payments, 25 to 35%, more expensive to secure, origination fees of 1 to 3%. However, if the property cash flows well, commercial lenders approve loans based on that cash flow. Your personal income matters less than the property's ability to pay the debt. Analyzing commercial properties. Commercial analysis is all about net operating income, NOI, and cap rates. NOI equals gross income minus operating expenses, excluding debt service. Cap rate equals NOI divided by purchase price. Example, a 10-unit building generates $120,000 gross rent annually. Operating expenses are $50,000. NOI is $70,000. If the property costs $1 million, the cap rate is 7%. Commercial investors compare cap rates across properties and markets. Higher cap rates mean better returns, but often indicate higher risk. Worse locations, older properties, higher management intensity. Cap rates also determine value. If prevailing cap rates in a market are 7% and your property generates $70,000 NOI, it's worth approximately $1 million, $70,000 divided by 0.07. This is powerful. If you increase NOI to $84,000 through rent increases or expense reductions, the property is now worth $1.2 million. You just created $200,000 in value. The value add strategy. Value add is buying underperforming commercial properties, improving operations, and forcing appreciation. Common value add opportunities: properties with below market rents, properties with high vacancy due to poor management, properties needing cosmetic improvements, properties with inefficient expense management, properties with utility or service inefficiencies. Example, you buy a 20-unit apartment building for $2 million at a 6% cap rate, NOI of $120,000. It's 70% occupied with units renting for $800 per month, below the $1,000 market rate. You renovate vacant units for $5,000 each, getting them rent ready. You fill them at $1,000 per month. You renovate occupied units during turnover, raising rents to $1,000. Within 18 months, you've increased occupancy to 95% and rents to market rate. New NOI is $200,000. At a 6% cap rate, the property is worth $3.33 million. You've created $1.33 million in value. Subtract your $100,000 in improvements, and you've created $1.23 million in equity. You can refinance, pull cash out, and deploy it into the next deal. This is why sophisticated investors love commercial real estate. You control value creation in ways residential doesn't allow. Commercial property types beyond multifamily office buildings, leased to businesses, longer leases, 3 to 10 years, provide stable income. Challenges include economic sensitivity and potential for large vacancy periods. Retail, strip malls, shopping centers, standalone stores, longer leases. Often with percentage rent, you get base rent plus a percentage of tenant sales. E-commerce has challenged retail, making it riskier. Industrial/warehouse, storage, distribution, manufacturing spaces. E-commerce has increased demand for warehouse space, typically low maintenance with long-term tenants. Self-storage, customers rent units to store belongings. Recession-resistant, people always need storage. Management-intensive but highly profitable in the right locations. Mobile home parks. You own the land, residents own the homes. Very sticky tenants, expensive to move mobile homes. Reliable cash flow with minimal maintenance. Each property type has unique characteristics, risks, and management requirements. Most investors specialize in one type, rather than spreading across all commercial categories. Chapter 18. Out-of-state investing. Many successful investors own properties in states where they don't live. This allows investing in markets with better fundamentals than your home market. Why invest out of state? Better returns. High-cost coastal markets often have low cap rates, 3 to 4%, while markets in the Midwest or South might offer 8 to 10% cap rates. Diversification. Owning properties in multiple markets reduces risk from local economic downturns. Growth markets. Some markets have better population growth, job growth, and economic fundamentals than others. Lower entry costs. A property in San Francisco might cost $1 million with minimal cash flow. The same $1 million buys 4 to 5 properties in lower-cost markets with substantial cash flow. Challenges of distance investing. Market knowledge. You don't have local knowledge about neighborhoods, schools, crime, or trends. Management. You can't drive by properties or meet tenants easily. Contractor relationships. You don't have established relationships with reliable contractors. Buying blind. You'll likely never see properties in person before purchasing. These challenges are solvable but require different approaches than local investing. How to successfully invest out of state. Step 1. Choose the right market. Research markets based on fundamentals: population growth, job growth and diversity, landlord-friendly laws, property taxes, insurance costs, price-to-rent ratios, crime rates. Use tools like city data, Census Bureau data, and local economic development websites to research. Look for markets with steady population growth, 1 to 2% plus annually. Diverse economies, not dependent on one industry. Reasonable property taxes and insurance. Price-to-rent ratios of 15 or less. Landlord-friendly eviction processes. Popular out-of-state markets include Indianapolis, Memphis, Kansas City, Birmingham, Columbus, and many others in the Midwest and South. Step 2. Build a local team. You need boots on the ground, essential team members, real estate agent, find an agent specializing in investment properties, interview multiple agents, ask about their investor experience, properties they own, and market knowledge. Property manager, critical for distance investing. They'll handle everything from tenant screening to maintenance. Interview property managers extensively. Visit properties they manage. Check references. Contractors. Your property manager should have contractor relationships, but having backup options helps. Inspector. Use professional inspectors for every property. Don't skip this. Attorney. Know a local real estate attorney for leases, evictions, and legal questions. Connections. Matter. Ask each team member for referrals to others. Great agents know great property managers. Great property managers know great contractors. Build a network. Step 3. Visit the market before buying. Visit your target market. Spend several days touring properties with your agent, meeting your property manager, driving neighborhoods at different times of day, getting a feel for the area. You can invest sight unseen after you've established relationships and understand the market, but visit before your first purchase. Step 4. Start conservatively. Your first out-of-state property should be conservative. In a solid B-class neighborhood, turnkey or nearly turnkey condition, with a proven property manager, in a market with strong fundamentals. Don't make your first out-of-state purchase a C-class fixer-upper. Learn the market with lower risk properties before getting aggressive. Step 5. Use technology. Video calls for property tours, digital document signing, online property management portals, and cloud-based record keeping make distance investing feasible. Your property manager can video tour properties, show you repair estimates via photos, and handle everything remotely. Managing the risks. Property manager. Risk. Your manager is critical and also your biggest risk. Bad managers can ruin your investment. Vet carefully, start with one property to test them, and monitor closely. Market research. Risk. You might misjudge a market or neighborhood. Conservative first purchases and thorough research reduce this risk. Distance disadvantage. Local investors might get first access to deals or better contractor rates. Accept that you'll pay slightly more for everything and factor it into your analysis. Despite the risks, thousands of investors successfully invest out of state. The key is building strong teams, starting conservatively, and accepting slightly lower returns in exchange for less hands-on involvement. Part 7. Long-term wealth, building and exit strategies. Chapter 19. Building generational wealth through real estate. Real estate isn't just about monthly cash flow or flipping profits. It's one of the most effective vehicles for building wealth that lasts generations. The power of compounding in real estate. Compounding in stocks is straightforward. Returns generate more returns. In real estate, compounding is multidimensional. Income compounding. As rents increase, your cash flow grows. You can reinvest that growing cash flow into more properties, accelerating portfolio growth. Equity compounding. Appreciation and loan paydown build equity. You can leverage that equity through refinancing to acquire more properties, compounding your equity growth. Tax compounding. Tax savings from depreciation and deductions. Preserve more capital for reinvestment, accelerating wealth building. Management compounding. Systems and teams you build for early properties make acquiring additional properties easier and cheaper, reducing the marginal cost of each new property. Let's run the numbers on a simple example. Year 1. Buy one $250,000 property with $50,000 down. Cash flow, $300 per month. Year 2. Save cash flow plus other savings. Buy second property. Now earning $600 per month from 2 properties. Year 3. Buy third property using saved cash flow and equity from appreciation. 3 properties earning $900 per month. Year 4. Buy fourth and fifth properties. 5 properties earning $1,500 per month. Year 5. Buy sixth and seventh properties. 7 properties earning $2,100 per month. By year 10, if you maintain this pace, you own 15 plus properties generating $4,500 to $6,000 monthly cash flow. By year 20, you own 30 plus properties. Many early properties have mortgages paid off or nearly paid off. Cash flow might be $15,000 to $20,000 monthly. That's life-changing wealth created from consistently acquiring properties and letting time do the heavy lifting. Passing wealth to the next generation. Real estate offers unique advantages for generational wealth transfer. Step up in basis. When you die, your heirs receive a stepped-up cost basis equal to current market value. All the appreciation during your lifetime escapes capital gains taxation forever. Example, you bought a property for $200,000 that's worth $600,000 when you die. Your heirs inherit it with a $600,000 basis. If they sell it for $600,000, they pay zero capital gains tax despite $400,000 in appreciation. This is incredibly powerful for family wealth preservation. Trusts for property ownership. Holding properties in trusts allows controlled transfer to heirs while providing asset protection and tax benefits. Types of trusts commonly used: revocable living trusts, avoid probate, provide privacy, irrevocable life. Insurance trusts, estate tax advantages, family limited partnerships control assets while transferring value. Work with an estate planning attorney to structure ownership for your goals, teaching the next generation. Unlike liquid assets that can be quickly spent, real estate provides ongoing lessons in management, finance, and business. Involving children or grandchildren in property management teaches valuable skills while they benefit from the assets. Many wealthy families build real estate portfolios specifically as teaching tools and income sources for descendants. Chapter 20. Exit Strategies and When to Sell. Everything we've discussed assumes you buy and hold long-term, but sometimes selling makes sense. Understanding when and how to exit is crucial. Reasons to sell investment properties. Market peak. If your market has experienced rapid appreciation and you believe a correction is coming, selling at the peak preserves gains. Rebalancing. If 1. Property has appreciated significantly and represents a large portion of your portfolio, selling and diversifying reduces risk. 1031 exchange. Selling to trade up into larger properties through 1031 exchanges defers taxes while improving portfolio quality. Life changes. Retirement, relocation, or simplification of life might prompt selling properties. Problem properties. Some properties are consistently problematic, high maintenance, bad locations, tenant issues. Sometimes cutting losses and redeploying capital elsewhere is smartest. Opportunity cost. If a property is underperforming and you have better investment options, selling and redeploying might optimize returns. Tax reasons. Sometimes tax situations make selling advantageous even if you'd prefer to hold. How to maximize sale price. When you decide to sell, maximize value. Timing. List properties in spring or early summer when buyer demand is highest. Property condition. Make cost-effective improvements that boost value. Fresh paint, landscaping, minor repairs. Don't over-improve. Tenant situation. Properties with good tenants on leases sell better than vacant properties. Stable rental income attracts investors. Financial documentation. Organized financial records showing income and expenses help buyers analyze the property and justify higher offers. Professional photography. High-quality photos dramatically improve online listing performance. Pricing strategy. Price competitively based on recent comparables. Overpricing leads to properties sitting on the market. Agent selection. Work with agents experienced in investment property sales. They understand investor buyers and can market accordingly. The 1031 exchange decision. When selling, you'll face the decision, pay capital gains taxes, or do a 1031 exchange. If you've held the property long-term and have substantial gains, the tax bill could be massive, potentially 25 to 30%. of your profit between federal capital gains, depreciation recapture, and state taxes. A 1031 exchange defers these taxes indefinitely by reinvesting in another property. The rules are strict. Identify replacement property within 45 days, close within 180 days, use a qualified intermediary, buy equal or greater value, reinvest all proceeds. Most serious investors use 1031 exchanges to defer taxes and continuously upgrade their portfolios. When to sell without exchanging. Sometimes paying the taxes and taking the money makes sense. You're retiring and want to simplify. You need the cash for other purposes. You want to exit real estate entirely. The tax bill is minimal because you haven't held long or don't have much gain. Consult with your CPA before deciding. The tax implications are significant. Part 8. Real-world case studies and scenarios. Chapter 21. Real investor success stories and what you can learn from them. Theory is great, but real-world examples show you how actual investors built wealth. Let me walk you through several case studies of investors who started with little and built substantial portfolios. Case Study 1. The house hacker who built a 15-property portfolio. Meet Sarah. At 26, she was earning $55,000 as a teacher with $15,000 saved. Most people would say she couldn't afford to invest in real estate. She proved them wrong. Year 1. Sarah bought a duplex for $220,000 using an FHA loan with 3.5% down, $7,700. Her mortgage payment was $1,400. She lived in one unit and rented the other for $1,100. Her net housing cost was $300 monthly instead of the $1,200 she'd been paying for an apartment. That's $900 monthly savings, or $10,800 annually. Plus, she was building equity through appreciation and loan paydown. Year 2. Sarah saved aggressively, putting away $1,500 monthly between her rent savings and reducing other expenses. After 18 months, she had $27,000 saved. She bought a second duplex for $235,000, again using an FHA loan with 3.5% down, $8,225. She moved into this duplex and rented both units of her first duplex for $1,100 each. Her first duplex now generated $2,200 rent against a $1,400 mortgage, producing $800 monthly cash flow after accounting for vacancy, maintenance, and management. Her second duplex cost her $300 monthly to live in, same as before. Year 3. Sarah refinanced her first duplex from the FHA loan into a conventional loan, which allowed her to remove the mortgage insurance and improve cash flow to $950 monthly. She saved her cash flow plus continued savings, accumulating $28,000. She purchased a single-family rental for $180,000 with a conventional loan, 20% down, $36,000. She partnered with her brother, who contributed $20,000 while she contributed $16,000 and handled all management. The single-family rental generated $500 monthly cash flow, which they split 50-50. Years 4 through 10. Sarah continued this pattern, alternating between house-hacking duplexes with FHA loans and purchasing rentals with conventional financing. She used BRRRR on 2 properties, finding fixer-uppers that she renovated and refinanced. By year 10, Sarah owned 7 duplexes, 14 total units, 3 single-family homes, 1 fourplex, 4 units. Total, 21 rental units, generating approximately $8,500 monthly cash flow. Sarah's total out-of-pocket investment over 10 years was roughly $175,000. Her net worth from real estate equity exceeded $850,000. Key lessons from Sarah's story. Lesson 1. House hacking solves the capital problem for beginners. Sarah's low down payments on owner-occupied properties allowed her to acquire real estate despite limited savings. Lesson 2. Living below your means accelerates wealth building. Sarah didn't inflate her lifestyle as her income grew. She maintained her $300 monthly housing cost and saved aggressively. Lesson 3. Consistent acquisition matters more than perfect timing. Sarah bought through various market conditions, focusing on properties that cash flowed rather than waiting for the perfect market. Lesson 4. Leverage partnerships when capital is limited. Sarah's partnership on the single-family rental allowed her to do a deal she couldn't afford alone. Lesson 5. Reinvest profits rather than spending them. Every dollar of cash flow went back into the next property, creating compound growth. Case Study 2. The flipper who transitioned to buy and hold. Meet Marcus. At 32, he was a contractor earning $70,000 annually with $30,000 saved. He knew construction, but nothing about real estate investing. Year 1. Marcus identified a distressed property for $140,000 that needed $40,000 in repairs. After repairs, it would be worth $220,000. He bought it using a hard money loan, 15% down on purchase, $21,000, plus $10,000 of the repair costs from his savings. The hard money lender financed the remaining $30,000 in repair costs. Marcus did much of the work himself over 3 months, saving on labor costs. Total repair costs came in at $35,000 instead of the projected $40,000. He sold the property for $215,000, paying off the hard money loan. $140,000 plus $30,000 equals $170,000, plus interest $8,000, and selling costs $15,000. Profit $22,000 on a $31,000 investment in 3 months. Year 2 through 4, Marcus completed 8 more flips following the same pattern. Some were more profitable, $35,000 to $40,000 profit. Some less profitable, $15,000 to $20,000. Average profit was $28,000 per flip. Over 3 years, 8 flips generated $224,000 in profits. But Marcus paid substantial taxes, roughly $70,000, because flips are taxed as ordinary income, not capital gains. After taxes, he had $154,000 plus his original $30,000, totaling $184,000. Year 5, Marcus realized flipping was trading time for money. He was working 60-hour weeks and paying high taxes. He decided to transition to buy and hold. He used his $184,000 as down payments on 4 rental properties, averaging $250,000 each. 20% down equals $50,000 each, using $200,000 total, including closing costs. These properties generated $1,800 monthly combined cash flow. Years 6 through 10, Marcus continued flipping occasionally, 2 to 3 per year, but used profits exclusively for rental property down payments. By year 10, Marcus owned 14 rental properties, generating $6,300 monthly cash flow. His equity exceeded $1.2 million. Key lessons from Marcus's story. Lesson 1. Flipping generates capital quickly, but isn't a long-term wealth strategy. Marcus used flipping as a tool to accumulate down payment funds for rentals. Lesson 2. Leverage existing skills. Marcus's construction knowledge gave him an edge in estimating repairs and managing renovations, reducing costs and risks. Lesson 3. Tax efficiency matters. Marcus's transition from flipping, taxed at ordinary income, rates up to 37%, to buy and hold, benefiting from depreciation and capital gains treatment, dramatically improved his after-tax returns. Lesson 4. Active income can fund passive income. Marcus's labor-intensive flipping work created capital for passive rental income, allowing him to eventually reduce his working hours. Lesson 5. Strategic pivots accelerate wealth building. Recognizing that flipping alone wouldn't build long-term wealth, Marcus strategically shifted to a better long-term strategy. Case Study 3. The out-of-state investor who scaled through cash flow. Meet Jennifer. At 38, she lived in San Francisco, earning $120,000 as a software engineer with $80,000 saved. San Francisco's real estate market offered terrible cash-on-cash returns. Properties cost $800,000 plus and barely broke even on cash flow. Year 1. Jennifer researched markets with better fundamentals and lower prices. She chose Indianapolis, where properties cost $150,000 to $250,000 and generated strong cash flow. She flew to Indianapolis, spent a week meeting agents and property managers, touring properties and neighborhoods. She built a team, an investment-focused agent, a property manager with 15 years experience, and an inspector. She purchased 2 turnkey rental properties for $185,000 each, $370,000 total, with 25% down, $92,500 total including closing costs. Each property generated $1,500 monthly rent against $900 in mortgage payments and $500 in operating expenses. Cash flow, $100 per property, $200 total monthly. The cash flow was modest, but Jennifer was building equity in $370,000 worth of real estate with only $92,500 invested. Year 2, Jennifer's properties appreciated 4%, $14,800. Loan paydown added another $8,000 in equity. Total equity gain, $22,800 plus $2,400 cash flow. She saved her cash flow plus $2,000 monthly from her job. After 18 months, she had $54,000. She purchased 2 more Indianapolis properties at $195,000 each using the same financing structure. Her portfolio now included 4 properties generating $400 monthly cash flow and building substantial equity. Years 3 through 7. Jennifer continued the pattern, acquiring 2 to 3 properties annually. She focused on Indianapolis initially, then expanded to Kansas City and Memphis for diversification. By year 7, Jennifer owned 18 properties across 3 markets. Monthly cash flow, $3,200. Portfolio value, approximately $3.6 million. Total equity, approximately $1.4 million. Year 8, Jennifer's software engineering income had grown to $180,000, but her real estate portfolio's cash flow and equity growth made her realize she could achieve financial independence through real estate. She made a bold decision. She negotiated to go part-time at work, 3 days per week, taking a pay cut to $110,000, but gaining time freedom. Her real estate cash flow, $38,400 annually, combined with part-time income, $110,000, maintained her lifestyle while giving her more time to find deals, oversee her portfolio, and enjoy life. Years 9 through 12. Working part-time, Jennifer accelerated her real estate acquisition. She had more time to find better deals, cultivate relationships with agents and wholesalers, and optimize her properties. By year 12, she owned 32 properties generating $7,800 monthly cash flow, $93,600 annually. Her net worth exceeded $2.8 million. At age 50, Jennifer retired completely from software engineering, living on her real estate income. Key lessons from Jennifer's story. Lesson 1. Out-of-state investing allows accessing better markets. Jennifer's willingness to invest outside her expensive home market dramatically improved her returns. Lesson 2. Building a strong local team makes distance investing viable. Jennifer's careful selection of property managers and agents allowed her to successfully invest from 2,000 miles away. Lesson 3. Modest cash flow compounds. Significantly, Jennifer's individual properties generated modest cash flow, $100 to $300 each, but 32 properties produced substantial total income. Lesson 4. Real estate enables lifestyle design. Jennifer's portfolio allowed her to shift from full-time work to part-time, then to retirement on her own timeline. Lesson 5. Geographic diversification reduces risk. Jennifer's properties in 3 different markets protected her from local economic downturns affecting any single city. Chapter 22. Common scenarios and how to handle them. Real estate investing involves dealing with challenging situations. Here's how to handle common scenarios. Scenario 1. Your tenant stops paying rent. This will happen eventually. Here's the exact process. Day 1. Rent due. Rent doesn't arrive. Send a friendly reminder via text and email. Sometimes tenants genuinely forget or have a payment processing issue. Day 3. If still no payment, call the tenant. Find out what's happening. Are they temporarily short on funds, lost their job, having an emergency? If it's temporary and they've been good tenants, you might work out a payment plan. Document everything in writing. If they're evasive or this isn't the first late payment, proceed to step 3. Day 5 to 7, deliver a pay or quit notice. This is a legal document giving them a specific number of days, usually 3 to 14 depending on your state, to pay rent in full or vacate. Deliver it properly according to your state's laws, usually posted on the door and mailed. Day 14 to 21. If they haven't paid or moved, file eviction paperwork with the court. You'll need to pay filing fees, $150 to $400 typically. Week 4 to 8. Attend the eviction hearing. Bring documentation, lease agreement, proof of non-payment, copy of pay or quit notice, communication records. If you win, you almost always will for non-payment cases, you'll receive a judgment and writ of possession. Week 8 to 12. If the tenant still hasn't left, the sheriff will physically remove them. You can then change the locks and regain possession. The entire process takes 1 to 3 months depending on your jurisdiction. This is why having reserves is crucial. You'll go months without rent while paying the mortgage and legal fees. Never attempt self-help eviction. Don't change locks, remove belongings, or shut off utilities. These are illegal and can result in you being sued and fined heavily. Scenario 2. Major, unexpected repair. You get a call. The roof is leaking badly. The roofer says it needs complete replacement, $15,000. Step 1. Verify the assessment. Get 2 to 3 estimates from different roofers. Sometimes the first roofer is overpricing or recommending unnecessary work. Step 2. Check your reserves. Ideally, you have $15,000 in your property reserve fund. If so, write the check and schedule the work. If you don't have sufficient reserves, you have several options. Option A, use a home equity line of credit, HELOC, from another property. If you have equity in your primary residence or other rentals, a HELOC provides quick access to capital at reasonable rates. Option B, use a credit card with a 0% promotional APR, then pay it off before interest kicks in using cash flow over the next 12 to 18 months. Option C, work with the contractor on payment terms. Some contractors will allow you to pay half up front and half in 30 to 60 days, giving you time to gather funds. Option D, consider a cash-out refinance if you have substantial equity. This gives you capital for repairs, plus replenishes reserves, though closing costs make this better for larger amounts. Step 3. Communicate with your tenant. If the repair affects their use of the property, roof leak causing water damage inside, you may need to offer rent reduction, temporary relocation, or expedited repairs. Step 4. Document everything for taxes. Major repairs that extend property life, like roof replacement, are capital improvements you can depreciate, providing tax benefits. Prevention. This scenario underscores why CapEx reserves are non-negotiable. Budget for major replacements and maintain reserves for each property. Scenario 3. Inheriting a tenant. When you buy. You bought a rental property with a tenant in place. The tenant seems fine initially, but after 3 months, they start paying rent late, and the property shows signs of neglect. Step 1. Review the existing lease thoroughly. What are the terms? When does it expire? What violations has the tenant committed? Step 2. Document everything. Take photos of property condition. Note every late payment, every lease violation. Step 3. Send formal written notices for any lease violations, late rent, property damage, unauthorized occupants, whatever applies. Give the tenant opportunity to correct issues, but make it clear violations will not be tolerated. Step 4. When the lease expires, offer renewal at market rent with stricter terms or choose not to renew. Depending on your state, you may need to give 30 to 90 days notice of non-renewal. Step 5. If the tenant commits serious violations before lease expiration, begin eviction proceedings following your state's process. Prevention. When buying occupied properties, thoroughly vet existing tenants during due diligence. Request rental payment history, communication logs, and property condition documentation from the seller. If the tenant has a history of problems, factor that into your offer price or require the seller to remove the tenant before closing. Scenario 4. Market downturn. The market crashes. Property values drop 20%. What do? First, don't panic. Real estate is cyclical. Downturns happen. They're temporary if you're in a fundamentally sound market. Second, evaluate your cash flow. If your properties still cash flow positively, the decline in market value is just paper loss. You can hold through the downturn. Third, resist the urge to sell. Selling during a downturn locks in losses. Unless you absolutely must sell, hold and wait for recovery. Fourth, look for opportunities. Downturns create buying opportunities. If you have capital and stomach for risk, buying during downturns can be extremely profitable. Properties you couldn't afford before might become available at attractive prices. Distressed sellers, foreclosures, and motivated transactions increase. Fifth, strengthen your financial position. Build reserves, reduce expenses, and ensure you can weather extended downturns. The 2008 financial crisis taught crucial lessons. Investors who panicked and sold took massive losses. Investors who held and continued buying built enormous wealth as markets recovered. Scenario 5. Scaling beyond conventional financing limits. You've acquired 10 properties using conventional mortgages. You're hitting lender limits. How do you continue growing? Option 1. Portfolio lenders. These are banks that keep loans on their own books rather than selling them. They can lend beyond the conventional 10 property limit. Build relationships with small local banks and credit unions. Explain your portfolio, show your track record, and inquire about portfolio lending programs. Expect higher interest rates, 0.5 to 1% above conventional, and shorter terms, 15 to 20 years instead of 30, but you can continue acquiring properties. Option 2. Commercial loans. Transition to commercial financing for properties with 5+ units. Commercial loans have no limit on the number of properties, though qualification is property specific. Option 3. Private money. Cultivate relationships with private lenders, individuals who will loan you money for real estate investments. Offer them attractive returns, 8 to 12% interest secured by the property. This gives them better returns than savings accounts while providing you capital. Option 4. Creative financing. Use seller financing, lease options, subject to, or other creative strategies that don't involve traditional bank loans. Option 5. Syndications pool money from multiple investors to buy larger properties. You control the deal, they provide capital. This scales you beyond your personal lending limits. Chapter 23. The Psychology of Successful Real Estate Investing. Real estate success isn't just about numbers and strategies. Your mindset determines whether you succeed or fail. The abundance mindset scarcity thinking says, if I don't buy this property, I'll never find another good deal. This leads to desperation, overpaying, and bad decisions. Abundance thinking says, if this deal doesn't work out, another will come along. This leads to patience, discipline, and waiting for properties that truly meet your criteria. There are millions of properties. Thousands change hands daily. Another deal always exists. Adopt. Abundance thinking. Be willing to walk away. Never let FOMO, fear of missing out, drive investment decisions. Delayed gratification. Real estate rewards patience. The investors who succeed think in decades, not months. They're willing to live in a duplex for a year to save money instead of renting a nicer apartment, drive a used car instead of a new one to save for down payments, work evenings and weekends managing properties to avoid management fees, reinvest cash flow into more properties instead of upgrading their lifestyle. The investors who fail want immediate gratification. They buy properties hoping to flip quickly for huge profits. They spend cash flow on lifestyle instead of reinvesting. They expect passive income without putting in the work first. They quit after 1 or 2 years when wealth hasn't materialized. Emotional detachment properties are assets, not homes, unless you're house hacking. Don't fall in love with them. Buy based on numbers. Sell based on numbers. Manage based on systems, not feelings. Emotional attachment leads to overpaying because you love the property, holding underperforming properties because you're attached, being too lenient with bad tenants because you like them, making decisions based on feelings instead of financial analysis. Successful investors are unemotional. They follow their systems and criteria regardless of how they feel about a property. Long-term thinking. Your first property probably won't change your life immediately. Neither will your second or third. But property 10 might start feeling significant. Property 20 might generate enough cash flow to quit your job. Most successful real estate investors took 10 to 20 years to build substantial wealth. Not 2 years, not 5 years. 10 to 20 years of consistent, disciplined acquisition and management. If you're not willing to commit to a decade-plus timeline, real estate might not be for you. Continuous learning. Real estate is complex and constantly evolving. Markets change, laws change, strategies change. Successful investors never stop learning. They read books and blogs, they listen to podcasts, they attend seminars and conferences, they network with other investors, they consult professionals, CPAs, attorneys, property managers. They analyze their own performance and adjust strategies. Investors who think they know everything after buying a couple properties quickly fall behind and make expensive mistakes. Commit to being a perpetual student of real estate. The learning never stops. Risk management real estate involves substantial risk. Successful investors don't avoid risk, they manage it. They manage risk through conservative underwriting, assuming higher expenses, lower rents than projections, maintaining substantial reserves, diversifying across multiple properties and markets, proper insurance coverage, legal entity structure for asset protection, professional property management reducing operational risks. Unsuccessful investors either ignore risk or are paralyzed by it. Find the middle ground, acknowledge risks, understand them, and implement strategies to mitigate them without letting fear prevent action. Final thoughts. Real estate investing is a journey, not a destination. You'll make mistakes, you'll have difficult tenants, unexpected repairs, and challenging markets. But if you stick with it, if you keep learning, keep acquiring properties, keep managing them well, you'll build wealth that changes your life and potentially your family's lives for generations. The difference between those who succeed and those who fail isn't intelligence, luck, or timing. It's persistence, discipline, and willingness to do the work, even when it's hard. You now have the knowledge, you have the roadmap, you have real-world examples of ordinary people who built extraordinary wealth through real estate. The only question remaining is, will you take action? Your future self is watching. Make him proud.